All right, the AI boom is absolutely everywhere, right? But what if I told you there's a hidden engine humming beneath it all? We're going to pull back the curtain and uncover this really surprising connection between the hottest tech on the planet and the exact kind of financial risk that led to the 2008 crisis. So yeah, let's dive in.
So what is the connection here? How does a cutting-edge AI company have anything to do with a financial meltdown from over a decade ago? Well, it's a fascinating question, and the answer, it turns out, is this really complex game of money, tricky valuations, and a huge unregulated lending market that's just been quietly ballooning in the shadows.
To really get this, we've got to start with a very specific and honestly a pretty strange kind of deal that's become super common in the world of high-stakes investing, especially when AI companies are involved. They call it a GP-led continuation deal.
So a continuation deal is basically a way for an investment firm, the general partner, or GP, to hang on to its star performers, its winning companies, for a lot longer than their funds usually allow. How? Well, they simply sell the asset from one of their old funds to one of their brand new funds. And that, as you can imagine, creates a very weird situation.
Yeah, you heard that right. The buyer and the seller, they're literally the same firm. They're sitting on both sides of the table, setting the price for something they're selling to themselves. I mean, talk about a conflict of interest, right? It's a huge red flag, and you can bet regulators and investors started paying very close attention.
So because of this obvious risk of self-dealing, a whole industry of independent advisors has popped up. Regulators like the SEC and even the fund zone investors, the LPs, they all demand some safeguards. They require these independent fairness opinions to make sure the price is actually, well, fair.
Now, this system of checks and balances works pretty well until the asset being sold is an AI company, something that is notoriously difficult to put a price on. It's almost like trying to value a ghost.
And here's the fundamental problem. You see, traditional companies, they get valued on stuff you can actually measure. Things like revenue, cash flow, what similar companies have sold for. But these early-stage AI companies, they're valued on stories. They get a price tag based on these grand narratives about future breakthroughs, often using forecasts that come from the very same firm that's trying to sell the asset to itself.
This whole valuation headache creates real problems. These AI deals drag on forever. They cost way more in advisory fees, all because no one can agree on what the company's actually worth. And the investors, they get skeptical, and a lot of times they'll just decide to take their cash and get out, which can kill the whole deal right there.
Okay, so now let's zoom out a bit. All of these tricky deals are being financed by this enormous and frankly super opaque market, the world of private credit.
See, after the 2008 financial crisis, a bunch of new rules made it much harder for traditional banks to make risky loans. But the appetite for that risk, it didn't just vanish. Nope. It just moved out of the regulated banking system and into this huge, lightly supervised shadow market that's run by private equity firms.
And to manage all this new risk, these private lenders are using a tool that might sound a little familiar. They slice up the loans into different layers, or tranches. Each one has a different level of risk, a different potential return. And if that sounds a lot like how mortgages were bundled up before 2008, well, you are definitely on the right track. So here's how it works when you're funding an AI company. The safest slice of the cake, the senior debt, that's backed by hard assets, things you can actually touch and sell, like data centers and GPUs. But the riskiest slice, the equity, that's backed by, well, the AI magic. It's backed by the hope and a prayer of a huge future breakthrough. And you've got this middle layer, mezzanine debt, that's kind of in between.
And this, right here, is where the whole structure of today's AI lending starts to look, well, eerily similar to the one that blew up so spectacularly back in 2007.
Okay, just look at this comparison. It's kind of spooky. Back in 2007, the asset was housing. Today, it's AI infrastructure and, let's be honest, a whole lot of hype. But the risk structure? It's the exact same tranche waterfall system. The illusion of AAA safety at the top? Check. The fact that nobody really knows what's inside these bundles? Double check. It's like the entire machine is identical. We've just swapped out the fuel.
This quote just nails it. It's the perfect short seller's pitch against this whole market. What you've got is a system that's leveraged up to the hilt, completely hidden from public view, and where the value of everything is decided by the very people who make money when those values are high.
So that brings us to the biggest question of all. If this system is so obviously risky, why is it even allowed to exist? How in the world has it grown into a multi-trillion-dollar behemoth?
Well, the answer lies in the foundation that this whole thing is built on. A foundation that is so incredibly stable, it actually encourages people to build these unbelievably risky skyscrapers on top of it.
This entire global house of cards, all the private credit, all the fuzzy AI finance, it all rests on one single thing: the perceived absolute invincibility of the US financial system. It's seen as the ultimate safe harbor, the bedrock that makes all the crazy risk-taking possible. So these three pillars create a system that basically no other country on Earth can replicate. First, you've got an unwavering rule of law that actually enforces contracts no matter what. Second, you have US Treasury bills, T-bills, which are seen as the world's ultimate safe asset. And third, you have the repo market, which is the engine that makes the whole system go.
And this is where the real magic happens. The US doesn't just issue debt. It issues the core collateral that keeps the entire global financial system running. A T-bill isn't just an IOU from the government. Through the repo market, it becomes like a universal pawn ticket you can use to borrow cash overnight. And because the Federal Reserve guarantees this market will never ever freeze up, T-bills are essentially as good as cash, anywhere in the world.
And that brings us to the final, really critical thought here. The underlying plumbing of the financial system, the part anchored by the US, it's probably more solid than it's ever been. But think back to 2008. The problem wasn't the plumbing itself, it was the toxic mortgages that were flowing through it. So today, the pipes are strong, sure, but now they're being filled with these opaque, impossible-to-value AI loans. And the question we all have to ask is, do we have any idea what's really flowing through the pipes this time?